This video is second part covering long-term or non-current liabilities in our course. So this video builds on the previous one, whereby we saw how bond prices are calculated and the initial terminology that we needed to understand the bonds and how they impact their financial statements. So in this video we're going to talk about how bonds that are issued at a premium or a discount, how do these issuances have an impact on how these are reflected on our financial statements. We'll be talking about most of the video will be focused on the learning outcome B, which is describing the effective interest method and calculate interest expense, amortization of bonds, discounts and premium, and interest payments. So moving on, we have already covered this slide. So at the time of issuance, as we have already talked about this, at the time of issuance, the interest rate that equates the present value of the future bond cash flows to its price, it's called the effective interest rate. Bond issuance is essentially a financing activity, thus the cash flow that is derived from issuance of bonds is obviously reflected in the financing section of the cash flow statement. So just to recap, let's just go through an example. So there's this company that has issued a £1 million face value bond. Face value is 1 million. So we're just going to go through this example just to recap on what we had previously done. So this bond is for a maturity of 5 years, okay, and coupon rate is 5%, and what is the sales proceeds of the bond when issued, and the market interest rate is also 5%. So we need to find out the sales proceeds and the issuance, how it's reflected in the balance sheet. So what we are going to do, we are going to build a timeline. For every year we are going to receive a coupon of 5% and 5% of the face value, right? So this is the coupon that we are going to receive, and there's something wrong here, and we need to lock this cell. So we are going to receive so bond issuer is going to pay an interest of £50,000 for every year of its issuance, and the face value is 1 million. So annual cash flows will be sum of your interest payment and capital repayment or repayment of face value. So these are our cash flows. So we are going to calculate present value interest factor, which will be 1 divided by 1 plus the market interest rate, in this case this, raised to the power, for year 1 it's going to be 1, and respectively it's going to, so for year 2 it's going to be 1 divided by 1.05 raised to the power 2, because there are 2 years for discounting this cash flow. For 3 years it's raised to the power 3, and so on. So present value of these cash flows will be, PV of cash flows will be the cash flow at time 1 multiplied by interest factor of time 1, and similarly we move on. So the issuance price for all these bonds is price at issuances. So the sales proceeds that that D-Bond Corp is going to receive for this bond is £1 million. So we see over here, when market interest rate and coupon rate are the same, the issuance price is same as the face value of the bond. And how it's reflected in the cash flow statement, within the financing activity, it's going to be proceeds from issuance of 5 years maturity, 5% coupon bond, and we're going to write 1 million in front of that. This is going to be on a cash flow statement. And on the balance sheet, it's going to reflect on the year-end balance sheet. We're going to reflect as non-current liabilities, and it's going to be it's going to reflect like this on the balance sheet. So moving on, we are going to see work out another example, which is bonds issued at a discount. So I'm just going to copy everything from here. In this example, what we're going to do is we're going to see another bond being issued. Now the characteristics for this bond are it's again £1 million face value, 5 years maturity, market interest rates are 6% in this case, so we're going to change market interest rate. So sales proceeds and issuance, how is the issuance going to reflect? So we're going to determine our cash flows. The cash flows are a coupon rate of 5%, and a face value of £1 million. So since the coupon rate is same, the interest payments are going to be, interest payments, payment at maturity, let's say annual cash flows. So basically the change in market interest rate is going to have an impact on our present value interest factors from the previous example, and then we calculate the price at issuance to be 957,000, and balance sheet is going to reflect this. So this bond will be issued at a discount. So moving on, what we are going to do is so what we have seen is companies initially report bonds as a liability on their balance sheets at the amount of the sales proceeds net of issuances. So now we are going to work through an example through the life of a bond. So over here we have an example from a textbook. This is £1 million face value bond issued when the market interest rate is 6%. The sale proceeds are 957.8. So basically it's building on the same on the previous example. We need to find out what the interest payments are. So quickly we'll just go through the numbers again. Face value is 1 million. Coupon rate is 5%. Market interest rate at issuance is 6%, and interest payment. So interest payment is always, for a fixed rate bond, interest payments are basically your face value times your coupon rate. So this is going to be 50,000 over the life of the bond. So this is what the first requirement for the example is. Number 2 is what amount of interest expense on the bonds would be reported in 2017 and 2018 using the effective interest rate method. So basically what we need to understand over here is, let's say these bonds that were issued on 1st of January 2017, and we recorded a liability of 957,876 pounds on a balance sheet. So over the course of next 5 years, this liability has to catch up to the face value, which is £1,000,000. So basically what we are going to see over in this example over here is basically 1 million minus 957,876. So the discount on this bond at issuance was 42,124 pounds. So over the life of this bond, this 42,124 has to be periodically adjusted to the carrying value of our liability on the balance sheet. So how we are going to, how this 957,876 carrying amount of our liability has to converge to a million. So we have to, there are two ways of going about it. First, we are going to see the effective interest rate method. So in this method, what we are supposed to do is, whatever the discount or premium the bond has, it's allocated to the carrying amount of a liability on the balance sheet over the life of the bond by using the market interest rate that was prevailing at the time of issuance. So the market interest rate for this bond at the time of issuance was 6%, right? So what we are going to do is, for every year we multiply the market interest rate with the opening carrying value of the bond. So in this case, sales proceeds were 957,876. So what we are going to do is, on 1st of January 2017, let's try to format this a bit so it's easy to read. So on 1st January 2017, the carrying value of the bond was so during the year the interest expense expense will be, for this year the interest expense will be the carrying value multiplied by the market interest rate at issuance, which is going to be, since it's an annual coupon bond, so we don't need to divide this 6% by anything. So interest expense for the year 2017 that is going to be reported on an income statement will be 57,000, and interest payment to our bondholders will be 50,000. How is this determined? It is determined by the face value times your coupon rate, right? So 50,000 is the interest payment. So the difference between our interest payment, and our interest expense is basically the reduction in our or increase in our carrying value. So this is the carrying value at the year end, which will be 957,000 plus 7437. So next year, 1st of January 2008. Now this is the opening carrying value, and this is the, let's say, so the opening carrying value is going to be the same as the closing from previous year. The interest expense is going to be the opening carrying value times the market interest rate at issuance. Interest payment, it's going to be the same, million times the coupon rate, and the difference of interest expense and interest payment is going to be, so second year of issuance we see the carrying value increase by 7,921. So we are going to repeat this for the 5 years of issuance, 17, 18, 19, 20 and 21. So previous year's opening interest expense should be, now so at the end of, on 31st December 2021, our bond has almost converged towards a value of £1,000,000. So interest payments over the life of the bond remains the same, while we amortize using the effective interest rate method. So just to go through this example once again, we had a bond with a face value of £1,000,000, a coupon rate of 5%, the interest rates at the time of issuance was 6%, the sales proceeds were $957,876. So using the effective interest rate method, what we did, for every year we multiply the market interest rate with the opening carrying value of the bond. So opening carrying value for the first year was 957,876. We multiplied that by 6%. The interest expense was $57,473. We had to make an interest payment of $50,000 to bondholders. It's depending on the face value and coupon rate. So the difference between your interest expense and amortization was basically 7,473. So the ending value of the liability increased by to 965,3 349. So every year at year end, these are the values of the liability that we are going to report on the balance sheet.